It is the College Financial Health Show with Matt Hendricks and Gary Stocker. Welcome to this show for Tuesday, January 14th, already the middle of January in 2025. We're doing the show a little bit differently today. We saw that two colleges, Gannon University and Ursuline College in the Northeast, announced a merger a couple of weeks ago, and we're looking at both colleges individually. And Matt and I will talk about what some of the opportunities and even challenges will be for this merger. Hi, welcome to the show. My name is Gary Stocker, founder of College Viability.
And I'm Matt Hendricks, founder of Perspective Data Science. As Gary mentioned, we're going to look at Gannon University and Ursuline College. One's in Pennsylvania, Gannon, and the other is in Ohio. But I guess they're close together, Gary. They're like
I think so. I
90
think they're along Lake Erie in
or
some
so.
form or fashion.
So yeah, I'm going to be fairly brief. I'll just show you the financials of the two schools, and generally my sense is that Gannon is the stronger of the two,
Yeah.
financially, and it looks like even in the merger, it looks like it's basically Gannon acquiring Ursuline, which I think is probably a smart move. Although I worry a little bit about them losing a bit of their unique mission. So those are some questions I would ask if I were a stakeholder. But I'll get into the financials first. In particular, so Ursuline is a predominantly women's school. We just checked it, and it's like 1,000 women and less than 100 men at Ursuline. Um, and Gary is Gannon is, admitting both
Co-ed.
gender.
Yeah, it's
Yeah,
co-ed.
go ahead. So, yeah, just that's one thing that you'd wonder about. Is keeping that's the biggest thing with a merger, right? Of a
Yeah.
nonprofit or of a university in particular, is just maintaining your mission. And if your mission is to serve women and you're merging with a school that doesn't have that same mission, those become tricky. All right, so let me get into the financials though. Starting with Gannon, the stronger partner, and I'll show you why I think they're stronger. They don't have their 2024 audit in yet. Ursuline does, so we have the 2024 data for them. But this is the key driver for financial sustainability here is that are your revenues exceeding your expenses for operations? And almost every year, Gannon has the
Yeah.
positive. In fact,
That's good.
every year, positive net income margin. Excellent. Big positive during COVID, right? It's pretty common. You can see the median line going up there because it got all this government support and actually didn't lose many students. So nice result there. So they look good. Cash flow is negative here. That's probably some anomaly because their cash flow is positive on all of these. And as you know, if you've seen other shows, cash flow from operating activities should be higher than net income because you're taking out depreciation expense. So it'll pump up your operating cash flow margin. So I didn't look at this in particular why this went negative because I'm not concerned about this school financially, but there may be some timing issue or, maybe they changed their accounting and started taking their net out as possible as well. But you can try to understand that if you're one of these stakeholders. So one thing to check, and I already know because just looking at this, but let's take a look at their revenues and expenses. We should see that their revenues have, sort of tracked with expenses. Looks like they had a big net income back here and a slightly smaller one. So you'd expect to see the revenues hopefully going up and expenses going up, but expenses slightly more. But I'll show you that. Let's take a look. I don't even actually remember what it looks like. There's operating revenue, and on the bottom graph, I'll put expenses, operating expenses. So what you're going to see here is the change since 2016. And so Gannon's operating revenues have grown by almost 17% between 2016 and 2023. That's better than median, so that's good. Their expenses have grown slightly faster, just exactly what I expected to see. Not a concern though. They still have a positive net income, so that's fine. Let's take a look at net tuition revenue. I put it here on the bottom graph. Their net tuition revenue has grown a lot. All right, this is well above the median school, 11.6% growth since
It is
2016.
rare that we see that, Matt.
Yeah, that's excellent. So this school's in a really good place financially, comparatively to what we've looked at. That's great. Their operating revenues up. Their key operating revenue of net tuition revenue is up. Let's take a look at their endowment management. Let's take a look first at the growth in the endowment. Their endowment has not grown
Hmm.
very quickly. Again, this is why it's really important to benchmark. Their board may not be aware that this is not good, right? You look at 31% growth in your endowment since 2016, you might think that that's excellent, but it's actually quite poor. The reason is that most schools are above 45%, all right, growth since 2016. So there's a problem potentially with how the endowment's been managed. Let's see if I can figure it out. I don't have every piece of information about the endowment in here, although I'll be adding that to the advanced compass here shortly. The big thing that I do have in here is appropriations, and that may reveal a bit about this. And I don't see it offhand. I mean, there are some big draws here in 2017. The recent draw in 2023 is a bit high, but certainly doesn't explain this gap. So if I were them, what this tells me is that you either have an issue with the returns not being
Yeah.
good, right? They're not maybe invested in the proper securities. Maybe their portfolio manager has put them in some stuff that doesn't move with the market. That could be a problem. Um, could have high fees on their
Yeah.
investments. That's another issue. Or they're just not contributing enough to their endowments. They're not getting a lot of donor support. That's another thing to check. All of those will be in the advanced compass. Let's take a look at the last thing. Let's just take a look at their property and equipment. And this may explain why,
Yeah.
partly why the endowment's not growing as fast. Maybe all of their money is going into building. And usually you have a surplus and that money will go into your unrestricted endowment fund. But it looks like they're pumping it into buildings and or acquiring other campuses. So interesting strategy. The school is growing quite a bit in terms of physical capital, buildings, equipment, machines, that kind of stuff. They're up 56, almost 58% since 2016. That's going to be, one of the highest in the country. This is the 75th percentile right here. So they're
Yeah.
well
We
above
hardly, we hardly
75.
ever see that. We hardly ever see that also.
Right. Yeah. And I already know what I'm going to see here, but their investment
Yeah.
in their property, plant, and equipment must be well outpacing depreciation. Yeah, and it is. It's like two and a half times depreciation every year. So this is a school that has obviously a growth strategy and not just growing, virtually. They're growing with buildings, campuses. I think I did actually read this in my prep this morning that they had another campus they were investing in addition to sort of
I believe it's in
acquiring
Florida,
Ursuline.
Matt. Yeah. It's in
Yeah.
Florida.
Yeah, you did see that. Okay.
Yeah.
Yeah, so that's the strategy here. And they seem to be doing quite well with it. They look very healthy, and I can totally see why they're acquiring schools. All right, so here's Ursuline College in Ohio. I'll start with the same stuff here at the top here with cash flow. Let me just say a little bit about these numbers. They look weird. They're really volatile in part because let me pull up their audit. So this is a problem. If you see this at your school, I highly recommend you look into getting a different auditor. This audit is not very useful, and you should have your board using the audit regularly to cross-check against your budget. And so the reason I'm bringing this up is this is Ursuline's statement of activities here compared to Gannon's. Notice just the difference in detail, right? This is
Yeah.
the standard look for a statement of activities. This is not. Here they don't have revenues broken out by operating versus non-operating, and in Gannon they do. These are operating revenues. This is non-operating
Yeah.
activities. Okay, and that's really important because like I said, you should be always cross-checking your budget relative to the audit. All right. And at least reconciling the budget to the audit. It's a lot more difficult if you're not breaking out operating versus non-operating.
Yeah.
So it's also difficult for me to benchmark your stuff because notice Gannon's pulling out it correctly, pulling out things that are not related to their operations. And what I'm trying to put into the compass are these numbers that are operating related. In particular, this one, their increase in that's their net income, right? The increase in net assets from operating activities. I don't have that for Ursuline College. I have their revenues, which includes non-operating things. I can't even really see a lot of the
Yeah.
line items that should be there. And expenses, same thing. We could have non-operating expenses in here. These aren't even broken out by the correct groups as
Yeah.
well. Notice they're doing natural expenses here, but what's typically done is a functional expense. This is totally fine to do it this way. There's kind of differences that way. But what they should be breaking this out is by instruction, by
Yeah.
student services, by
Institution,
institutional
academic
support, and
support.
so on. And again, really important that the board's cross-checking that and benchmarking that, not only against their own budget, but against other schools. And again, this audit is not helpful for that. I would immediately look for a different auditor if they can't comply or produce an audit that matches what we typically see.
Right.
Another issue, so I could look more closely at the cash flow statement. But here it's not even clear to me. Again, remember the issue where there's always schools pulling out investments out of
Yeah.
here. And the thing you worry about is if they're pulling out investments that are related to the spending policy for the endowment, ideally you would keep that in because that's operating revenue, right? It's not clear to me. I suspect they're keeping that in here, but it's not clear because this number should match what's reported on the statement of activities, probably 2 lines actually, but it doesn't match anything that's on statement of activities. So I'm not sure if they're pulling out the full endowment of value here or just the investments in excess of the draw. But at any rate, you can see that this is important. I would need more context to understand exactly what this means, but this is not good. You never want a cash flow unless you have a big endowment, like I said, and they're pulling out the endowment value. This school does not have a big endowment, but it's possible that if they are pulling out their endowment draw, that their net cash from operations would actually be still positive had they kept it
Yeah.
in. That's all that's to say, I don't really know what's happening with Ursuline here. These numbers look bad, and I would need to talk to their board and their auditor and their CFO to understand exactly what this means. But this is a net cash from operating activities that's negative 1.3 million in 2024, was negative 3 million the year before that. The way they're covering their expenses here is by selling investments. You can see that they're selling a bunch, 22 million in investments, only purchasing 17. So the net there is
About 5.
almost 5 million. Some of that went into repairing buildings and replacing equipment, right? Which is too low, as I think I'm going to show you here in a little bit. But yeah, it's not. So you can see right here, their depreciation is 1.8 million, and they only spent 600K on building and equipment. 1.6 million depreciation. They spent 1.2. So again, their property and equipment values going to fall off. That could be indicating some issues with loss of technology or deferred maintenance, stuff like that. So yeah, these are not good. I'm not happy. Of course, I wouldn't be happy if I were a board member here, and I'd want to understand why this is happening, make sure the accounting is squared away and is standardized with everybody else. And notice in contrast here, we have a positive net income from operations for Gannon, 13 million positive, 6 million positive. Typically, that money would be then invested in the unrestricted endowment, but this school is spending a ton of money on buildings. Wait, that's not the one. Buildings and equipment right here, 13 million, 16 million. So there, I already showed you those results, but that's just to say, make sure your audit is compliant with sort of standardized accounting standards and is useful, and that your board is using it. It's really hard to imagine that they're using that audit in decision making, and that's a big problem, just from a management perspective. Okay, so all that to say is this number is not very reliable up here because there's non-operating and operating mixed together. This one down here does not look good, right? You never want these negative cash flow numbers, and they're almost always negative here. So a really concerning financial result there. Again, I need more information, but that does not look good. Let's take a look at their revenues. Well, I'm not going to even do that because the revenues are not useful. Let's do endowment here. Change in endowment value. Yeah, so their endowment is not doing well again. This is another case where it's really important to benchmark against peers, because if you just look at your board is just sitting there looking at your endowment over time, it's not obvious that a 26% growth is bad, right? Most board members are not going to know that that's bad. The only way you know is by comparing it to other schools. And again, 26% growth for your endowment is really bad. over this period.
Compare is bad compared to your peers.
Yeah, bad compared to all the other schools, right? Actually, a better benchmark here would be to compare Ursuline to other schools with a similar size endowment. But my guess is you could still see the same thing. If you want to do that, you can do that in a strategic compass, or yeah, the paid app we've been calling it. You can see why their endowment's not growing, right, Gary? Look at these are endowment draws here: 13%, 11.8%.
They're using
These
their
are
piggy
all
bank to
like
keep the
way off
lights
the
on.
chart. What's that?
They're using a piggy bank to keep the lights on.
Yeah, those endowment draws are way too big, not sustainable, and your endowment's not going to grow very well. You can see it's
Yep.
shrunk actually since 2021. That's not normal, right? Most endowments have grown since 2021. Yeah, that's a problem. Again, another indication that there's something not right here at the finances. They may be having to cover losses with big endowment draws. I suspect we're not going to see a lot of investment in property and equipment here as well because they have financial struggles, and that's the case. The value of their property and equipment since 2016 is down almost 13%. Again, that's in the bottom 25% of schools, probably well below bottom 25%. And you can see why, again, just not investing much in their cap since, let's see, well, all but 2 years, their investment in their property, plant, and equipment is less than their depreciation rate over the
Yep.
last, what is this, 9 years. A normal value, again, if you haven't seen the previous shows, a normal value is a little bit above 1 so that you're maintaining your capital stock over time. Okay, that's the median, 1.03, 1.04, and so on. Only a couple of years it's been low because of COVID. Nobody was building anything during that time. But they're catching up now, right? So yeah, some issues there. Clearly looks like financial stress with the big draws on the endowment, lack of investment in capital equipment, potentially some issues with deferred maintenance, maybe some issues with the auditor, and just fiscal control. How's the board actually able to cross verify these things, which is a really important function of a board? Not sure that that's happening. Lots of questions I would have if I were a stakeholder. But it's good that they're joining up with Gannon. I'm sure they're going to benefit a lot from that partnership. And so I'll hand it back to you, Gary, but we can discuss more about what the challenges of that might be.
So yeah, so it's interesting that you use the term stakeholder for in the context for Ursuline, and it looks like Gannon is going to become a really big stakeholder.
Yeah.
And you and I both know when we do this show on a weekly basis that Gannon, Pace University, University of Mary are just two or three that come to mind that have been really strong. There are others that they don't come to mind right away. So Gannon really doing well, doing really, really well. And you'll see with the graduation rates here in a minute. If you're on the Gannon board, I assume, Matt, that you've looked at this stuff. If we actually put you on the Gannon board, what's your biggest concern?
Yeah, I guess the biggest concern I would have for any school that like Gannon that's expanding, building, they're acquiring other schools, is that if you do it too fast and take on, it becomes more complex. You're bringing in a different culture, a different mission. Got to integrate the staff somehow, different controls. It's going to be a lot of work, right? To just get
Yeah.
everybody on the same page. And then you worry that the stress of the merger might create financial problems, if, um, Gannon's not able to sort of translate their financial controls over to Ursuline very well. There's lots of issues that could potentially come out of that. I haven't obviously acquired another school, but I've heard of these discussions, big discussions like this, changing the mission, what happens to the current staff that's there. I'm sure with a merger, they're going to do a lot of shared services across the two campuses. So that means a lot of people are going to lose their jobs, right? There's a lot of growing pains, so to speak, involved with these.
And this is just an announcement. It's got to go through the review by the accrediting agency, by the Department of Education, and maybe banks and those kind of places. So it's not a done deal. But like you, I like what I see here. You've heard me say before, Matt, and I'll say it again, that while mom and pop mergers, which is what this is, two colleges coming together, I don't think it gets to enough scale. if I'm on Gannon's board, if you could appoint me to be on Gannon's board for a moment here, I would be looking at growing, but you make a good point. Don't grow too fast, but to really scale expenses, to really scale academic leverage, it really needs to be more than one college. And maybe Gannon has that in mind because I like what they're doing now. Hey, let's look at the 2024 College Viability app. I'll let you know the 2025 version will be out in the next few weeks or so. But let's start by looking at enrollment. And again, Gannon, we can see throughout my brief presentation, Gannon is doing well. And that week after week, we show FTE enrollment, and week after week, we show colleges with negative numbers. Gannon is not one of them. Almost 400 students, up 10% over the last 8 years. Ursuline does fall, expectedly, into that category of colleges who, while not down a lot, 46 students, do the math on tuition for 46 students, that becomes a significant number. That's why I like this. Gannon is big enough and is doing something right, Matt. We may not be able to pinpoint what they're doing right, but they're certainly doing something right. And when we look at graduation rates, same thing. Look at Gannon. Man, they're doing things right. Now, 55% is not exceptional. I will grant you that. But I'm not going to get into my spiel on graduation rates in great depth. My threshold is 50% as a minimum. Gannon exceeds that. And Matt, as you well know, not very many colleges graduate even half their students over 4 years. And Ursuline's one of those.
Yeah.
About 35% over the last 8 years is all that Ursuline is able to graduate. So again, if you're Gannon University and you're looking at this and you haven't looked at graduation rates, I got to think you have. You really want to ask the folks at Ursuline why it's so low and do what you can to fix that. Tying in with that, I looked at percent admitted. Interestingly, both are pretty high, so they're not very selective. Ursuline has been essentially unselective. They'll take almost anybody who applies. Gannon a little bit more selective than that. And I don't know if that's a bad deal. The only issue that I have with that is if a college is accepting students just for their enrollment dollars and they're happy with getting them enrolled and not graduating them, that's a big concern.
Yeah.
And when you are admitting a higher percentage of students, I can make a logical argument. It's tough to do in the data. I can make a logical argument that are you really prepared to help those less than prepared students graduate in 4 years? My operating premise, Matt, right or wrong, is that it's tough to do, and high admission rates are going to result in lower graduation rates. And then we even look at the yields for these two, the admissions yield for both. And, Ursuline, because they're a private women's college, they're a little bit on the high side. That's not right. They're a good number, around 20% admissions yield. Gannon has slipped a little bit. Be interesting to watch that in the coming years with a high percent admitted, and a decreasing yield rate. That's got to mean something. I'm not sure what that is, but again, if I'm on the
Yeah.
Gannon,
Well, can you quickly pull up applications?
I don't have applications on this
Okay.
version. Yeah, I don't.
Yeah, I see this a lot. Almost every school has a declining yield rate. It's mostly because a lot of students are submitting apps all over the place, right? With Common App
Oh
and
yeah, it's common to see that yield rate slip for sure. It
yeah.
really is. Yeah.
And it could be that, maybe Gannon's done a great job of building up the number of applications and you saw they're admitting like 85%. So you'd expect a pretty low yield rate in that case. But still, at the end of the day, who cares, right? If they get a lot of students that graduate, that's perfect.
Right. And for those watching the show, if you want to look at a deep drill down for your college, the strategic compass will do that. It will actually drill down on admissions and enrollment, and there's even an enrollment trend analysis that Matt has incorporated in the strategic compass. Look at the endowment value. I thought this was interesting. Ursuline's endowment per student is considerably higher than Gannon's. But when you look at the absolute numbers, Gannon's is about 3 times higher, a little bit more than 3 times higher than Ursuline's. My minimum threshold is 50 million. You saw during Matt's presentation that Gannon, while it has grown about 12 million, about 13 million, they have been spending on stuff. So again, they're growing their endowment a little bit, and also it looks like they're preparing for their future. So kudos to them. And then finally, before I look at the majors, let's look at tuition and fees. And again, you're not going to be surprised. Gannon has grown theirs. On the far right-hand side, they're about 12 million over the last 8 reported years into iPads. And Ursuline is down about 2 million, probably from those 40 some odd students. They are down in FTE enrollment since 2015. And so the last piece we're going to look at, and we started showing this a couple weeks ago, and it's the 2025 College Majors Completions app. So what we have, and this is the working version, the actual version will be out here shortly. This takes all public and private colleges in the country and compares their associate, bachelor's, and master's degree completions. So you can see I've brought up both Gannon and Ursuline on below, and let's set it up for initially for bachelor's. So we can see the number of bachelor's degrees that Gannon has awarded over the last 4 reported years, up about 1,000, and the same numbers for Ursuline. Well, that's fine, but let's drill down because we've got two colleges merging, Matt. Let's look briefly at where they're strong in academic and majors and completions and where they're not so strong. And you can see, again, if we're going to pick out a couple, they're strong in biology. They're strong in sports kinesiology. That's a nice little niche. And some decent numbers, but not great numbers in some of these others. Respiratory psych, maybe criminal justice, maybe business administration. These are students who've graduated with that major from Gannon in those reported years. And you can see the total numbers over the last 4 reported years over on the far right-hand side. Let's do the same thing for Ursuline. And again, when you look at the Ursuline numbers, I've expanded it right here. The numbers are much smaller. Gannon had about 1,000. Ursuline's not quite at 200. And as you look across the board, no real consistent strength with any significant numbers. Psychology is somewhat strong by comparison inside of Ursuline. Social work somewhat strong, but even that has dropped off a little bit from already small numbers. So here's a tool you can use if you're at Gannon, if you're at Ursuline, if you're anywhere else, and you're looking at majors to cut or majors to add at the bachelor level. Well, let's do the same thing, Matt, briefly for the master's. And again, now we're looking at graduate level completions for curriculum. Gannon clearly doing something well here. Business admin, they probably have an MBA program. PA, physician assistant. Big, again, Gannon just doing so many things so well. It's always good to see that. Maybe Ursuline, on the other hand, again, not going to be surprised. They've got a decent number, but not great for educational administration. And again, none of this should surprise the viewers. Gannon is strong across on the financial side. Gannon is strong by comparison on the completion side for majors. This is the kind of data, Matt, that we look at in this era of, and you've heard me say this before, Moneyball. This is the Moneyball era. You and I are just two of the folks, two of the groups, two of the individuals taking data that the colleges themselves provide and analyzing it and doing the comparisons. And you make a great point. You can't do this in isolation, Matt. You've got to do it by comparison.
Yeah. Yeah. It's like I said, I see a lot of boards using data, but just not bringing it to its full potential, right? Like looking over time at your own school is helpful to see trends at your own school. But if your school's always been weird and you have no idea, right? Like you just know, hey, your fees for your investments on your endowment are just not normal, and the returns are low, net of the fees, you would never know that just looking over time, right? You have to compare yourself to other schools. That's where the value of data really comes in.
Let's for a second talk about scale. You heard me mention a couple minutes ago that I don't believe mom and pop mergers. That's just my euphemism for 1 or 2 college mergers. I don't think that's enough. Do you agree or not?
I don't know. Honestly, I have the sense that schools of any size can survive if they're just managed well, right? If you just stay within your means, do what you do really well, I think you can survive and thrive in that kind of setting. I've analyzed schools that have fewer than 500 students, totally balanced budget, they're fine, right? And others with huge endowments and double that in students and just can't seem to get their budget balanced, right? So that's sort of the perspective I've come from. So I guess just in my experience, yeah, it's easier to balance a budget when you have more resources, more students, there's more flexibility. But I've seen some schools that are much smaller and are just very good at staying within their means. And I guess that's sort of the takeaway for me is it's more about just managing the place well, doing your thing well, and sustaining that over time, I think is the most important part.
And what we're seeing on this show is, yes, select small percentage number of colleges are doing that. But what we see throughout the industry is too many, and we see this on the show, are not balancing their budget. They're not doing a lot of financially worthy things. And as their last dollars circle the financial drain, they say, oh, please find somebody to save us. And I think that's more of a trend than strong colleges like Gannon, like University of Mary, like Pace University that we've seen are the exceptions to the rule. And the general rule is colleges are not doing what you suggest.
Yeah, yeah. There are a lot of resources out there. We're providing resources, right? If you're a board member on one of these schools, it's time. You want your school to survive. This is how you can do it. It's really simple, honestly. Just use the data and start asking questions, and you'll put your school on a path to sustainability that way. Just start asking questions, make sure you get answers and answers that make sense, right? Not just made up answers or intuition. You have to double check everything, and you'll probably find a route to sustainability that way.
So let's do this again next Tuesday, Matt, at 10:30
Yep.
Central Time. We'll have three different colleges on the show. For those watching this at the College Viability website, we have a page that shows future colleges we'll be covering. And as we do the announcement a couple days before each show, we tag you in our social media. You're welcome to join us. Drop me a note at Gary at College Viability, and I'll certainly get you on the show to join us to talk about your college. To get some suggestions. We can have a back and forth exchange. For Matt Hendricks, I'm Gary Stocker. We'll look forward to joining you next week. And as always, thanks for making time to watch the show. Take care.